Hello, everyone. Connor Darrell here from the WealthSpire investment team for our December update to our Markets in 2 Minutes series. So this is our last update of 2024, and so we're going to take some time to quickly reflect on what's been a strong year for capital markets, and then start to set the stage for what might be expected as we move into 2025. This is a chart we have used a couple of years in a row now, but we think it's a useful way to really summarize the past year. As we all know, 2024 was a busy year with a lot of potential reasons for markets to capitulate. And of course, that didn't happen, and the S&P 500 is set to produce its second straight year of 20+% returns. And of course, bond markets found some stability this year as well. And I think that's important to highlight because all of this took place in a rising rate environment, at least when you look at it from a point-to-point perspective. Each of the 5, 10, and 30-year Treasury rates are now higher than they were back in January, and yet bonds have still offered a reasonable rate of return. And that's because the income component is now sufficiently large enough that bond markets can still produce positive returns in periods where rates are trending higher. So overall, a very different starting point from where we found ourselves a couple of years ago. But overall, again, a very solid year for both stocks and bonds in 2024, assuming that those trends hold for the last couple of weeks here. And at this point, given 2 consecutive years of strong market performance, I think it's natural to sort of question how much longer that momentum can be sustained. But the good news is that the economy continues to trend toward a soft landing. And although we all know that an eventual recession is inevitable, it looks less and less likely that that will come in 2025, right? We have election uncertainty that's now been resolved. Jobless rates remain low. Household wealth is up dramatically since 2020, and the Fed is also now in cut mode. And that's all bullish for growth. We think this is an instructive chart here, which shows the trajectory of GDP growth historically in the lead up to a cutting cycle, and then also as the cycle matures. And you can see that there is a small lag, call it 12 to 18 months, but once that cutting cycle starts, it is very typical to see an acceleration of economic growth that can be quite significant. And that's just further support for the fundamental backdrop as we move into 2025. That doesn't mean that there aren't risks, right? We need to balance all of this against elevated equity valuations, a relatively chaotic geopolitical backdrop, and then some of the pending policy uncertainty, particularly surrounding potential tariffs. But with all of that said, we don't view any of those risks as significant enough to unilaterally tip the economy into recession. We are at a point in the economic cycle where it's important to monitor risks, but ultimately, for long-term investors, there's plenty of reasons to remain fully invested and optimistic about the opportunity for further gains across markets as we look forward. And so that probably means it's a good time to simply enjoy the holidays, spend some time with family and friends, and get geared up for 2025. At that point, we'll be back with our next iteration of the series and likely look to expand upon a lot of these ideas a bit further. So we'll see you all next year.